Get the recording started. So my name is Ryan Staton. I'm one of the managing partners here at StatonWalsh. For those that have had a chance to listen in on some of these in the past, you know what to expect. For those that haven't, uh, today we're going to spend some time going over what happened over the course of the third quarter, also the start of the fourth quarter. You know, I have a lot of newsworthy items to discuss. Some had relevance and effect on the market, some not so much. So the biggest of which being the government shutdown, which is coming to an end. It appears, but um, with that, there was a lot of debate on what was going to happen, when it was going to happen, what the outcome of that would be. The good news is, had it gone on another couple of weeks, this is what the White House probably would have looked like. As we all know, abandoned buildings or that don't have any business use turn into a spirit Halloween. So, good news is we're avoiding that. We don't have to worry about the White House becoming a spirit Halloween next year, but a lot of stuff still on the horizon. Um, Particularly any CR or continuing resolution, sorry, that is passed is temporary in nature, and so effectively, we're kicking the can down the road, and so there could be another conversation in regard to additional shutdown, after the first of the year into January or February, but that kind of remains to be seen, but this one got a good chuckle out of me at least. I enjoyed it. So let's talk about markets. Let's talk about what happened over the course of the third quarter. Um, Generally positive across all major indices in the US as well as abroad. Um, the highest performing index here in the United States was the NASDAQ Composite, heavily comprised of tech and growth stocks. No surprise there. S&P and this is all core in the quarter, in the third quarter. So that 11% number was just over the course of 3 months. Same for the S&P and the Dow, both up eight, little over 8% and about 5.5 respectively. The rest of the world, big, a big topic of conversation this year, at least for us in the investment world. Um, International stock markets have lagged U.S. pretty significantly over the past, let's call it, decade. This year has been an exception to that. There's been several segments of international markets, international developed, as well as emerging markets, which are smaller economies, smaller countries around the world, have seen a pretty good run up, at least from a stock market perspective. And that certainly has some value from a performance perspective for those that were invested in those asset classes. And so, for the third quarter, we saw emerging markets go up just shy of 11%. The MSCI World ex US total return, sort of a comprehensive measure of the entire international market index, was up about 5.4. And then the EAFE total return is more of a focus on developed markets. So think countries in Europe and other larger uh, economic powers that we see around the world. That index was up 4.83% for the third quarter of 2025. We go over this chart quite a bit. What's interesting is every quarter it changes slightly, and even on the 1 year, 3 year, 5 year, 10 year numbers as well. I don't think it's not a secret that U.S. large cap growth has been a dominant force over the past decade. A lot of large tech companies have had significant run ups in their share price. Um, and that really has been the darling of the ball for quite some time. If you were to look at this chart, rewind 10 years, you may have seen a little bit of a different makeup. Things like real estate were closer to the top of the list. Um, we've seen a major shift. You can see real estate is sort of a middle to the bottom of the pack asset class now when we look at this chart and zoom out. Year to date, though, and this is what I was mentioning on the previous slide, emerging markets and world ex US have been the highest performers. And so, um, a stark contrast. And if you look over the long term, what you could see is over the 10-year total, those have been kind of middle of the pack, largely driven by underperformance compared to U.S. markets, specifically U.S. large cap growth. but nonetheless, have been the highest performing asset classes so far this year, followed by U.S. growth and the S&P 500, which is considered a blend of both growth and value. So you see that value box directly below that on the year-to-date totals. Um, so a lot going on here, and a lot of movement, I think, in different asset classes when we talk about what does well in different markets or different periods of time. Um, and there's a lot of reasons why we see these shifts from time to time, and why certain things look differently. For example, commodities uh, a year ago were a high performing asset class, and today not so much. And so the takeaway is that markets are cyclical. I think for those who have participated in the market for some time, you grow to understand that. But more importantly, that no one asset class is superior to the other all the time. So transitioning sort of back to that government shutdown conversation. So a lot of questions we get is like, what does a government shutdown mean? And we'll talk about what it meant for the stock market here on the next slide. But just to give some perspective, when the government shuts down, this is a good visual representation of what happens, who's open and who's closed. And so Congress, as we know, is partially closed. There were still sessions, there were still votes happening, they're still getting paid. Um, you know, I know a lot of people have opinions about that, myself included, but partially Congress was closed during the shutdown. The Treasury is also partially closed. Housing Department partially closed. Things that were open or fully open for business, federal courts and Federal Reserve, two largest. Small business support was partially closed as well. So the SBA, anytime a department or a section of government is either fully closed or partially closed, it ultimately presents challenges. And SBA being one of them, a lot of small businesses rely on them for lending and other services. Those weren't fully available and have not been fully available. Um, the IRS was mostly closed. Unfortunately, that did not mean that didn't have to pay taxes during that time. That still happened, but this is just kind of a general overview of what was open and what's closed. And so, the biggest consideration is when there's no money or no funding, certain things can continue to function, but people just aren't getting paid. And so that's where you really start to see a lapse in services. And the biggest news was, airlines canceling flights, moving stuff around, offering refunds for folks, air traffic control. Those have been big topics of conversation because the reality is that when the government shuts down and any of these departments or these organizations shut down, life for us outside of the government still goes on. Services are still needed. People are still consuming goods and services. The economy still moves, but it just moves in a different way. And so, the takeaway from this, and what many suspect, is that if prolonged government shutdowns become a norm, what will the lagging effect of that be when we talk about economic activity and how people are spending money or not? Let's talk about what it meant for the market. So up until the 6th of November, so this is from the start of the shutdown up until right around the time the announcement of a deal was being made in order to reopen and fund the government. Um, Largely unaffected, I would say. Market was the S&P 500 relatively flat, the Dow Jones up slightly, and the Nasdaq up slightly as well. So the big takeaway was it didn't go in the opposite direction. This was something that I think for most investors, again, I kind of used the phrase before, life goes on. We still have things that we do, consume. Um, Largely to earnings reports and things that have come out during this time frame where the numbers and the data was already determined. And so sometimes when investors or the investment world is interpreting data, they're looking backwards, not forwards. And so now the market usually moves on a forward looking basis. And so what this kind of told us along the way is that there's always been an anticipation that the shutdown will end at some point. Things will get resolved. Not everything is resolved, and there's probably more conversation to be had there. But Generally speaking, the duration of the shutdown really didn't affect markets as much as maybe some would have anticipated. So let's dive into the macroeconomic data here. And so when we talk about this, things like inflation, wage growth, we'll talk about housing and some of the other items there. Um, what you could see is inflation has been pretty steady now. The peak of 9% back in 2022 with the run up of interest rates and the lagging effect of COVID stimulus and printing a bunch of money. We've seen some normalization or some stabilization of overall inflation data, respectively at right around 3% for both U.S. total inflation and core inflation. Um, you could see the consumer price index sort of just measuring a value of the dollar over time, or the spending power, I should say, of that dollar. Um, the really big, and I think the biggest issue when we talked about this frequently back in 22, 23, and even some parts of 24 was that wage growth had not kept pace with inflation. We were negative for on an inflation adjusted basis, which, in layman's terms just means the spending power of the dollar that you're making. You get cost of living adjustments every year, but those cost of living adjustments on your income are not keeping pace with the cost of goods. And so for a while there, and you could see for an extended period of time, we were negative. We're back in positive territory, or let's call it even at this point. But average U.S. hourly earnings are up about 3.69% is the exact number there. And average hourly earnings are about $36.53. And so we have seen I'll say, more significant growth of wages in recent, the past 3 to 5 years in comparison to when we look at historically what's happened. The caveat to that is inflation also ran up 3 times as much as it normally does on a year-over-year basis when we look at long-term averages. And so, naturally, all that has an effect. It has an effect on economic growth, how, what the feelings are at home in terms of, how much discretionary cash flow exists. And probably, I think most could understand the sentiment or get a sense that things feel a little strange right now. They feel a little weird. There's a lot of uncertainty and a lot swirling out there of what's going to happen. A lot of speculation on what's going to happen with markets, what's going to happen with economic policy, monetary, fiscal. All those things are relevant, and ultimately they're moving targets. And so when we look at the pure economic data, inflation has held pretty steady. It's ticked up a little bit to around that 3% number. We are positive on real average hourly earnings year over year, meaning inflation adjusted. We are ahead. So at least the increase of income has kept pace with inflation at least up until now. Employment. So another big topic of conversation, another economic indicator that people like to focus on. I think one I've talked this I've spoken on this many times, and I don't want to belabor a point, especially for those that maybe have heard me say it before. But labor force participation is still a problem. There are still a significant amount of job openings. However, um, it's important to note that, and I'll talk about this a little bit later about hiring and firing practices. Job openings have come down pretty significantly, obviously post in the middle of COVID and then beyond. There we hit a peak of about 12 million. That's trickled down to about 7.2. Um, but our labor force participation has not returned to the same place that it was prior to 2020 and prior to COVID. Um, so what does that mean? That means that many folks that exited the workforce are not returning. There are job openings and jobs available, but folks are not taking them, and so the replacement of labor force, especially with the baby boomer generation retiring, significant amount of retirees every single month. How do you replace labor force? There have been some pushes. Obviously, AI has become part of the conversation. Generally speaking, the consensus has been that AI is not going to completely replace people in a lot of fields. It's just going to be an enhancement and an enhancer of efficiency more than anything. That's the generally accepted, at least in the corporate world, and what we've seen. There are some cases where AI has changed the scope of certain jobs, but labor force participation continues to be an issue. Not a major issue, but it's something that I think is a point of focus. We saw sort of a run up where people got back into labor force, and we're starting to head on this trajectory of this curve. It's gone up, gone down, and it's kind of stayed steady at that lower rate. When we talk about layoffs and the hire fire conversation, that still has remained relatively low. So no peaks or spikes there. It's, as you could see, historically speaking, pretty steady and on par with what things have been, even as far back as this chart goes, which is into 2000. So, it's a 25, almost 25-year sample to look at. No anomalies there, nothing, particularly on the horizon. Now, again, there's a lot of speculation about what could or would happen. But from an employment data perspective, things look generally positive. The one thing that you always keep an eye on, just from a data perspective, is where is the unemployment rate? And it's a combination of all things, right? There's job openings, there's unemployment rate, there's also labor force participation. Certain people don't get calculated into formulas if they choose not to seek employment, and so that kind of skews certain data points as well. So, big picture, nothing particularly alarming at this point, but definitely something that will continue to be an area of focus for economists, and then also for institutions as time goes on. Um, Talking about GDP and public debt, I won't spend a lot of time on each of these charts individually. Here's what I'll say. We've had an interesting run up, since, post the Great Recession in '08 and '09. Debt assumption by the general public, both consumer and, think mortgages, cars, consumer debt, credit cards, personal loans, student loans, all of that becomes relevant in these conversations. Um, US debt to GDP, public debt is now in excess of GDP. It's 118% of that number. Um, in recent years, that I wouldn't say it's problematic at this point, but one of the reasons it's gotten a point of focus is obviously rising interest rates. Now, interest rates are on their way back down, but rising interest rates in combination with a significant run up in debt balances per household is something that most have been paying close attention to. Um, when we look at what's happened with, growth of the U.S. economy, it's grown pretty well, especially over the last, when we look at quarter over quarter, what's happened recently. More importantly, we have not seen any lending or loan bubbles, particularly in the consumer market. And, focusing on that data point specifically. Um, and some people there have been some speculations about 2008 and the housing bubble and, high interest rate mortgages and run up of price appreciation in that market. And is that going to be another bubble? It just hasn't come to fruition. People are on time. There's not a lot of delinquent mortgages. People are paying their bills for the most part. Now, that's not to say that everyone feels comfortable, and that they feel like things are going well, on a day-to-day basis, especially if you're living paycheck to paycheck, which unfortunately the majority of the country is. Um, this can feel like something that is a bit of a headwind on, especially from a wealth accumulation perspective. But this is something that is of particular interest to me, especially post 2020. You could see this part of the chart on that top right chart. That purple line is a sharp increase, and it kind of has a much sharper northeast trajectory there. Um, I think that's going to continue to be a point of conversation. Student loan debate is not going to go away. Other debt, mortgages. There's now this. We're going to get into housing here in a second, but the new introduction or the proposal of possibly offering 50-year mortgages has come into play to make housing more affordable for the younger generations. Um, we'll see if that actually comes to fruition, but a lot of debt is a huge stressor in the average U.S. household, and And frankly, it's something that is prohibitive to wealth accumulation for a lot of folks. And so I think it'll continue to be important. Continue to be a heavy topic of conversation, especially from a legislative perspective. When we talk about mortgage rates, so I know, in 2022, there was a significant run up of 30-year, 15, really pretty much mortgage rates across the board. There was an anticipation during that time that maybe in short order, those would come back to pre-pandemic or at least mid-pandemic levels. It just hasn't been the case. It has not come to fruition. A lot of different factors at play there, but generally speaking, from a mortgage and housing perspective, um, you're seeing a lot less mortgage originations than we saw in 2020. I think for obvious reasons, lower interest rate, a lot of refinances, a lot of purchases during that time. But price appreciation has mattered too. We'll talk about that here in a second, and where we are from a home pricing perspective. As of today, average 30-year rate is right around 6.3%, six and a quarter ish. 15-year rates are about 5.5, and so that varies bank to bank, and these are just averages. But the anticipation is that those will continue to come down. How quickly and when you'll see a mortgage with a five in front of it on a 30-year conventional, hard to say, hard to predict, honestly. And there's, like I said, there's a lot of factors at play. Big misconception. If the Federal Reserve cuts Fed funds rates, does not mean that mortgage rates will come down in proportion to that. We field those questions quite a bit. Mortgage rates are tied to different indicators and different metrics. 10-year Treasury plus a spread is usually a, a more accurate indicator of where mortgage rates will be. That's also some of the backing that's used for mortgages from a Treasury perspective. So, um, more to come on that. I think we're all gonna be in that boat together and figuring out when and how rates continue to come down, and when they normalize. I think normalization is key here as well. The 2%, 2.5% mortgages that we saw in 2020, 2021, not normal, as you could see from historical averages, well below the norm. And so I think the big point of conversation is understanding what normal will be for this year and beyond, and when if and when we get to a place where lower rates are possible, and what drives that. So there's a lot of things at play: economic factors, interest rate environment, and a few others. But I don't suspect that for those holding out for the potential of a 3% mortgage rate in a few years, I don't know that that's going to be realistic anytime soon. So I won't say we'll never see it again, because I always used to have opinions on when people would say that to me. We'll never see this again, and then somehow, some way, things always tend to happen. So um, I think that will be a another big topic of conversation. It's already being talked about legislatively. I mentioned that 50-year mortgage. Down on the bottom left there, I talked about mortgage delinquencies. You could see where it was in 2007, 2008, kind of leading up to the financial crisis and that spike. We're just not anywhere near that. So that's an indication, or a re-indication, that there's not really any significant worry or potential housing bubble on the horizon, at least from a mortgage perspective. This chart, as of late, has been very interesting to me, and I'm going to focus primarily on the left-hand side. So, for the first time in a really, really long time, we have had sustained prices. So, U.S. median home prices, it is now cheaper to build a new house than it is to buy an existing home. And it's been that way for a little bit. And it's kind of bounced back and forth. You could see there on the right hand side of that chart. But as of today, it's cheaper to build a home. And that may not, there's a lot of debate about that, about, materials costs and tariffs, and everyone kind of has differences of opinions on that. This is what the data tells us. So, median home sales price has run up pretty significantly since 2020, as you could see. And so that's been a part of the challenge and part of the issue. Um, with new or first time home buyers is higher rates, higher prices. That presents a challenge. What amount of homes are available to the average income household has shrunken, has gone down pretty significantly. So when your pool of supply shrinks and there's a bunch of people in the same boat as you, that increases demand. Basic economics, prices tend to go up, becomes more competitive, and then that's how we get to a place where we're at today. And so it's not far off. We're talking a couple $1,000s, but it is a significant shift in what conventional wisdom has told us and what historically has been the case, which is it's always a little bit more expensive to build a new home than an existing home. Now, to compound the issue, we also have a lot more opportunity to buy existing homes than new builds. And so, new home sales have averaged around 4 million, or excuse me, new home builds, single family homes, averaged around 800,000, while it's only been about 4 million or it's been 4 million, excuse me, for existing home sales. So, wide gap there, which largely I think drives some of the pricing conversation. But um, more to come on that. I'd be curious to see if that has staying power and if it truly is or ends up being cheaper the average sale price of a new build versus an existing home. If there's some sustainability to that price discrepancy or that flipping of what conventional wisdom has shown us over time. So I talked a little bit about this earlier, but sales and consumer sentiment. I think the general sense that we get when we talk to people and just talk about the day to day is like things just feel a little off, feel a little weird. I mean, um, in the area that we live in Maryland, and obviously our close proximity to DC, it's been compounded over the past month with shutdown of the federal government, a lot of government employees or government contractors or people whose employment depends on uh, the government being open have been largely affected. And so some of it has been regional in terms of some of the sentiment and some of the economic activity. But, when we look at nationally, um, year over year, we've seen retail sales hold steady. So there hasn't necessarily been a pullback, but I think it's an action versus a feeling conversation. Even though we've seen retail sales go up in the short term, you could see on that bottom chart, consumer sentiment has gone down pretty significantly. So the average sits at around 85. Right now, it's at about a 55, and so um, I think that's a measure of uncertainty. Like people are still spending money, they're still buying stuff. They're buying the necessities. There still is some form of discretionary spending happening out there. However, there is a general sentiment and a sense amongst consumers that things just don't feel right. They're not overly optimistic about certain things, and I think most are in, I'll call it a wait and see posture, um, to put it generally. So I'll be curious to see, as we get into the holiday season, this is obviously a time where retail heavily depends on the fourth quarter of the year. And that ultimately will affect movements in the market for some of the consumer discretionary sector as well. All right, treasury yield curves. A lot of stuff on the screen here. I think the important takeaway is that yield curves have started to normalize a little bit. They're not, and so what we mean by that is traditionally a longer term treasury, so that 30-year treasury rate would traditionally be the highest rate on the chart, and the shortest duration, that 1 month, would be the lowest. As you could see there, that's not exactly the case. You do see that the 30-year and the 20-year are on the higher end, but we're still seeing in the 1 month, 3 month treasury rates that they're a little bit higher than some of their longer durations. Um, During 2022, a good example of this, we had what was referred to, and we've had at various points in time, what's referred to as an inverted yield curve, where it basically means you can lend your money to the government or a corporation in a shorter duration and make more money than you would if you gave it to them for 30 years, and their bond would mature faster. And so, a lot of economically speaking, inverted yield curves usually lead to like panic. I'll say it, and bluntly, a lot of people panic and think that traditionally what that's meant is, recession is on the horizon. It didn't come to fruition. And so, what's interesting over the past handful of years is we've had a lot of examples of defying conventional wisdom. Um, and so, Treasury yield curve and Fed rates have been a part of that. The anticipation of when Fed rate cuts would occur, that has slowed. It didn't come down as fast as it went up. Um, and that seems to be the norm and the accepted norm at this point. There is a sense that again later this year there may be another rate cut, or at least that's something that's on the table. I think the market to this point has kind of anticipated that, and so if you watch any financial news, you probably heard, or if you haven't, there's a term that people like to throw out there calling, pricing is baked in. Basically means that it's already being considered, and that's part of the existing performance today. So, future action may not move the needle on the market on those items. Um, but more importantly, with the treasury yield curve and what we're seeing here, longer duration, and speaking to an investment perspective, short duration was better. You were getting better rates. You had liquidity. You could get your money, or your bonds would mature faster. Now that it's normalizing, that is pushing some of the investment conversations farther out on the yield curve, meaning looking at longer duration, 10, 20 year, and spending more time on long-term fixed income investments versus the short term. If you have any high yield savings accounts, you've also probably seen the effect of this in those. Those are generally variable rate accounts. And so every time the Fed cuts rates, you'll see your account crediting go down, equivalent to that. And it's usually pretty quick. Um, it reflects pretty quickly. And so same with money market accounts. And so cash becomes less attractive over time, especially with rates of inflation floating around that 3% mark. Once you get interest that's less than that, that's where conversations start to happen on, is there a better use of those dollars, at least from an investment perspective. So um, this is something that a trend that we expect to continue, normalization of the yield curve, and barring any changes, drastic changes in policy or Fed rates. I suspect that as we continue to do this, these charts you'll see more of a traditional, um, bottom to top organization of low rate to high rate on this chart here. Um, I cannot get away from talking about alternatives, primarily because they've been gaining momentum, and I think that it's good reason to talk about them. There's always good reason to talk about alternatives, but specifically, there's been a lot of news and promotion of specific types of assets, and the two most commonly talked about right now are precious metals and cryptocurrency. Cryptocurrency's been on everyone's radar for a while. Gold kind of goes in and out of favor. Gold and silver, I should say, goes in and out of favor. But what we've seen in short order when we look at year to date, the price of gold um, has run up almost 47%. Silver's up 39%. Bitcoin, um, over this is just a measure of the Q3 numbers, was up about 5.5%. And Ethereum, which is another cryptocurrency, if you're not familiar with it, ETH for short, was up almost 70% during that same time frame. So, why are we talking about this? I think that alternative investment and alternative asset classes, they tend to be cyclical conversations, but frankly, they're relevant, and they're really always relevant. But as you're comparing, these, what you hear and what you see versus the real data, I think we'd be doing everyone a disservice by not talking about them and talking about their place. Now, um, just because, going back to my original conversation about asset classes, just because one particular asset class is doing really good right now does not mean that you got to push all your chips to the center of the table. Diversification still matters. Um, we are not averse, or do not recommend against, I would say, investment in alternative asset classes, whether it be the ones on the screen or the many others that exist out there. I think it's important to understand their place and their purpose and how much you want to participate in that. These are snapshots in time. I could pull, and I'm not one to try to cherry pick data. You could pull any period in history, and I could show you the good, the bad, the ugly of both of these that are here on the screen. Um, Generally speaking, they have a place. I mean, I think there's some um, skepticism about cryptocurrency and its staying power. It's been around for a while now. It hasn't really gone anywhere. It's in and out of favor periodically, but um, it's here. It doesn't appear to be going anywhere anytime soon. And gold and silver have been a conversation forever, and will continue to be in their appropriate cycles. And so, um, right now, these are two very interesting assets that have seen, pretty significant growth in the past year and significant performance changes. And I think that everyone looking at these as potential alternatives for investment. I'm gonna go back to my answer that might sound like a broken record, but you got to make sure that it fits for your own circumstances. These numbers look great in theory, but you want to make sure that you have a full understanding of where they fit, why they fit, and what effect they could have, both positive and negative, on your own personal situations. So, with that, I'll just talk about some concluding thoughts and put a bow on all of this, and then we can open the floor for some Q&A. Um, the U.S. economy has defied odds. It's been relatively resilient despite a lot of skepticism and concern about what's going to happen with tariffs and geopolitical environment and the government shutdown. And there's been a lot of anticipated headwinds, and the economy just really is not responded, at least negatively, to those headwinds. It's been generally, I use the term, in air quotes there, positive vibes across financial markets. We haven't seen a lot of disruption or change. We saw in the early part of the year when the tariffs were announced, there was some short-term reaction to that kind of normalized. Things got back to the way that they were, and that's not always the case. I do want to be clear about that. But financial markets as well as the economy have been relatively resilient. Now, the real key here is maintaining discipline and being mindful of potential risks. So going back to my last slide, performance looks great, and it's always going to look better when it's in hindsight, meaning when we can look backwards and we can see what things have done, and we see that they've done 30, 40, 50%, that looks great. And that I don't want that to be an indication of that might be a good place to invest money, or because the economy is resilient and the markets have been resilient, like it's full steam ahead and everything should be the way that it is. Um, there are potential risks on the horizon. I'm going to talk about them here. The biggest is record highs, inflated valuations. They present a story. I mentioned that baked in pricing conversation. A lot of the good has already been kind of absorbed and digested. The market has reacted to that. And so that's generally why we see when things are going really well, we may not see big, 10% days or 5% up, 5% upswing when a piece of good news comes out. But it may be the reason why when we see bad news, we see those sharp negative reactions in markets where we see 2, 3, 4% in one day, like we did earlier in the year and at different points along the way. Um, those risks still exist. The high valuation, the inflated valuations in certain asset classes and certain sectors, those risks are not going away. I think valuations specifically are important because historical precedent points to at the current average valuation, where the current averages are and where valuation levels are today. And so just to kind of reiterate that or say that a different way, valuations are the measure of the stock price versus items like, are they actually profitable? Is there cash flow? During COVID, we saw instances of that where companies would have valuations that were like 40 times revenue and they weren't making a dollar in profit, which, you know, practically speaking, doesn't make any sense, just to put it in plain terms. And so valuations do matter. They matter over the long term. But when we look at historical precedent, we look at where valuations are today, that leads us to believe that there may be some potential for below average future returns with US indices. So S&P 500, NASDAQ, Dow Jones, for example. those are not all built or created equally, but in an increased valuation environment, those are concerns. It doesn't mean that there's going to be a recession or depression or major market downturn. That's not a prediction of that. It's more about setting expectations that when we have, 20, 30% years and we start stacking them consecutively, those things tend to not go on forever. And at some point, things cool off, and you may see less than expected or less than anticipated rates of return in certain asset classes or certain major indices. The cooling job market is also a point of focus. Um, this is more closely attributed to the higher fire uh, uh, conversation that I mentioned. A lot of the cooling job market seems to be, at least from the data that we see, more heavily attributed to reduced hiring versus increased layoffs. So we're not seeing as much telling us that people are losing their jobs. It's just that companies are reducing their hiring. And so you saw in that previous chart, job openings are going down. Some of that is because positions are being filled. Some of that is companies are just closing those positions and they're not hiring to them at all. And so that's going to be something to pay particular attention to as time goes on. Spending and debt levels from a government perspective, I don't think this is any secret to anyone out there, but they're still at levels that just don't seem to be sustainable long term. At some point in time, there's going to have to be some balance. We're going through the exercise and have gone through the exercise of a bunch of refinancing or reissuance of U.S. debt this year. And that was part of the focus from the current administration, trying to get rates down so they could refinance the debt at a cheaper rate. Um, Minimal success there, but the spending and debt levels just long term don't see sustainable. And at some point, I think those conversations come to a head, and there's going to have to be some change. There was the attempt of the Doge movement earlier in the year to cut spending, really didn't make much of a dent, frankly. Um, it was a little bit more of I think it was more newsworthy than it was effective. And so that is something that is certainly on the horizon and will continue to be a debate with some of these, beyond this continuing resolution and the next tranche of funding government and what legislation gets done. There's midterm elections next year. All this is going to continue to be on the table, and I think we're going to be hearing quite a bit about it over the next, 10 to 12 months. So what's my overall or our overall perspective as a firm? We still have, I've mentioned the phrase cautious optimism. That remains the theme in the current environment. I still am relatively optimistic about where things are headed. Um, there are still the headwinds that I've mentioned on the horizon, both from a market perspective, economic perspective, and some things just need to develop. They need to bake a little bit more for I think everyone to really have a full understanding and a full interpretation of um, what's going to be happening there. Um, for investors, prudent management of risk is going to be very important moving forward. Um, Putting all your money in a singular index or focusing on a particular sector, large cap growth, technology, whatever it may be, um, that's not going to be in my opinion, it's not going to be a viable long-term strategy. And so, to some degree it's worked out. And so, um, it sort of sounds unconventional. It may sound unconventional for some, but, you want to focus and understand your own specific risk tolerance and mirror that with the goals of specific accounts. And so what I mean by that is, taking more risk, and this is just hypothetical and not don't take this as a blanket recommendation, but in theory, if you're younger and you have a longer time horizon, their risk appetite in a retirement account that could be 20, 30 years away from you reasonably accessing it, that could be a place where you take a little bit more long-term risk because there's, time. You have time in the market for and really time to absorb some of the fluctuation in the market versus money that you need in the short term. Um, in the next few years, inside of 12 months, you shouldn't be looking at cryptocurrencies or gold or any risk-based assets um, that could potentially lose any significant sum of money. And so that's just a really brief example of the conversations that you should be having. But I think um, prudent risk management is going to be really important when we talk about investment and portfolio management, especially in the near term and going into next year. I would also remain cautious about over concentrations to specific asset classes. So even if you're in index funds, it is important to remember, or mutual funds or ETFs, each of those funds has underlying individual stock or bond holdings. You want to pay attention to those and make sure you understand what you own. If you don't, it's a fairly easy exercise, and there's tons of tools and technology. For those that are clients of ours, they've seen some of the work that we do on that side, but over concentration is sometimes accidental. And so it is relevant because, one over concentration in one specific asset class or company, even if it is unintentional, can cause some larger fluctuations or potentially some bad experience with market movements if the tide turns in the opposite direction. And so diversification is key to managing risk and long-term expectations. Perfect example is international markets were not very attractive, or for those that did invest in them, fun to invest in, up until recent history. Now, if you did this year, you've had a great year as a result of that. So there's always going to be winners and losers. I always like to tell people in our role, in our job as fiduciaries, it's like if we properly diversify an investment portfolio, we're always going to have to apologize for something. There's always going to be one, it might just be one thing, it might be a couple, but there's always going to be something that's not keeping pace or not doing exactly what everything else is doing. And that is by design, believe it or not. That also reduces risk over time. It helps create a smoother ride in a lot of cases. And so you just want to be mindful of these things. One thing I didn't put on this slide, but I'm going to emphasize it just because I have to, and it really is about this idea of risk management, especially transitioning into periods of uncertainty, volatility. If we start to see choppy markets and a bumpy ride ahead, products are not a solution. I say that because every day I'm on LinkedIn and I see someone pitching some idea of product or the golden ticket, the silver bullet, whatever you want to call it. Um, there are a lot of products out there, financial products specifically, that make sense in certain situations. Not all of them are perfect or prevent from or insulate, I should say, you from risk. Um, there are people out there, and legally, this is possible to do. And I'll get off my soapbox here in a second and let people ask questions. But I just want to make sure that everyone on this call understands, if you have a plan, make sure what you're buying and what you're investing in fits into that plan, and that it's not based on some fear or anticipation of what the market will do or not do. There's tons of great financial accounts, products, whatever you want to call them, out there. They all have a place, but they certainly should not be the leading decision maker in what to invest in. And so stick to a plan. Talk to either internally in your own household, with your professionals, with our team. Talk about prudent risk management, talk about diversification, talk about having a more well-rounded investment approach, and more importantly, pairing your goals and objectives with how you're approaching that conversation. I think you do those things, um, everyone will be in for uh, positive experiences in the rest of 25 and beyond. So with that, I will turn it over to questions, and everyone, if anyone has any, there's a Q&A, there's also a chat box. Feel free, chime in, ask any questions, and um, happy to answer. And I know we're 10 minutes to the hour, so for those that want to stick around, feel free. If you need to get back to your day, I'm happy to give you some time back, but we appreciate everyone and appreciate your participation. All right. Thank you. Well, if there aren't any questions, and for those, feel free if you have questions or something more specific, you want to ask offline, feel free to reach out to us. You can reach myself or Devin, and feel free to let us know if there's any way we can help. But thank you again. Thanks for joining us on this Wednesday, and we look forward to seeing you guys. I think we'll do one more of these maybe before the end of the year or right after the we turn the calendar over. But thanks again. If we don't speak with you, I hope everyone enjoys their holiday season and well wishes to everyone and their families. Thank you.